What if I told you there's one account that gives you a tax deduction when you put money in, grows completely tax free, and then lets you pull it out tax free when you need it? It's not a Roth IRA, it's not a 401k, it's the Health Savings Account, or HSA. And here's the kicker: most people use it wrong. Most people swipe their HSA debit card at the doctor's office, and in doing so, they throw away hundreds of thousands of dollars in potential retirement savings. Stick with me because I'm going to show you why your HSA could be the most powerful retirement account you've never considered. We'll look at case studies from people in their 30s, 40s, and even 60s who've turned their HSAs into retirement gold mines. Hi, I'm Casey Kraft, a financial advisor with Raymond James. On this channel, I share practical strategies to help you build confidence with your money, prepare for retirement, and make financial decisions that give you more independence and freedom in life. I believe God gave us all the talent and ability to increase our wealth, but it is His desire for us to steward what we have well so that we can be a blessing to others. The HSA is the only account with a triple tax advantage. Number one, contributions are tax deductible. Number two, the growth is tax free. And then number three, the withdrawals for medical expenses are tax free. No other account in America does all three. Not a Roth IRA, not a 401k, only the HSA. But a very important note, you can only contribute to an HSA if you are enrolled in a high deductible health plan. If you do not have access to that plan, you cannot contribute to an HSA. But here's the secret with the HSA is you don't have to use it for medical expenses right away. Most people swipe their HSA debit card at the doctor's office. That's not the worst move you can make, but it's also not the best. Instead, pay your bills out of pocket and let the HSA money stay invested. You can reimburse yourself years later, even decades down the road, as long as you keep the receipts. That's not just a healthcare fund, that is a retirement strategy. Sarah is a high-income earner with a high-deductible health plan. She maxes out her HSA contribution every year, $4,300 in 2025. Instead of spending it, she invests the entire balance in a diversified index fund. She pays her medical bills out of pocket and saves her receipts. By age 65, assuming a 7% return, Sarah has almost $230,000 in her HSA. And because she kept every receipt, she can pull that money out completely tax-free. That's like a stealth IRA hidden in plain sight. Kevin and Lisa are a married couple in their mid-30s. They contribute the family maximum, $85.50 a year, and invested. Assuming a 7% return, by the time they're 65, they'll have over $800,000 in their HSA. That's enough to cover a huge chunk of healthcare costs in retirement and potentially free up other assets for travel, hobbies, and legacy goals. Here's another twist. After age 65, you can take HSA withdrawals for anything, not just medical expenses. They will be taxed like a traditional IRA, but the penalty goes away. So that means if you build up a large savings account, you now have the option to use it for regular retirement income if you choose. Jim has always thought of his HSA as just for doctor's visits. At 62, he had about $70,000 saved in cash in his HSA. By looking at his HSA plan sponsors investment options, instead of just sitting in cash, that money is now invested. Now he just needs to worry about holding on to his receipts. By 70, again, assuming a 7% return over the next 8 years, that balance is now around $120,000. Jim now uses his HSA for qualified long-term expenses, saving thousands in taxes every single year. Here are the top 3 myths about HSAs. Number 1, I'll never spend that much on healthcare. You crazy? False. The average retired couple today spends over $300,000 on medical expenses. Number 2, if I can't afford to fund an HSA and pay bills out of pocket, even small contributions add up. $100 a month over 20 years grows into $50,000 plus. Number 3, HSAs are risky because I might not use the money. After 65, again, you can use it for anything, no penalty. Maximizing your HSA in 2025. Number 1, contribute the max. This year, it's $4,300 for individuals and $8,550 for families. Number two, invest the balance. Please do not leave it sitting in cash. Invest those funds. Number three, save your receipts. Use a secure digital folder or app. Number four, plan for the long term. Think of your HSA as a retirement account, not a checking account. And then number five, catch up at 55 plus. Don't forget the extra $1,000 contribution you're able to make. Most people see the HSA as a piggy bank for doctor's visits, but now you know the truth. It's one of the most powerful retirement accounts available today, combining the best parts of a Roth IRA and a traditional IRA in one. Quick question before we wrap up. Would you use your HSA as a healthcare account or as a retirement account? Drop your answer in the comments. I'd love to hear your strategy. If this video helped you, hit that like button, subscribe for more retirement strategies, and share this with a friend who has an HSA but might not be using it to its full potential. And if you'd like to see how an HSA could fit into your personal financial plan, click the Calendly link in the description. I'd be happy to walk you through it. And remember, wealth isn't just about numbers. It's about creating security and freedom for your family and stewarding resources so you can live generously. Thanks so much.